Real estate markets move in cycles, influenced by economic conditions, interest rates, demographic shifts, and broader financial trends. Understanding these cycles and knowing how to respond can mean the difference between substantial profits and costly mistakes. Unlike stocks, which can swing wildly in short periods, real estate cycles typically unfold over years, offering patient investors time to strategize. However, failing to recognize where a market stands in its cycle often leads to poorly timed purchases, premature sales, or missed opportunities. This guide breaks down the 4 key phases of real estate cycles and provides actionable strategies for when to buy, hold, or sell to maximize returns while minimizing risk. The first phase, recovery, follows a market downturn and is often the hardest to identify. During this period, prices have bottomed out, but pessimism still lingers from the preceding crash. Vacancy rates remain high and few buyers are active, creating opportunities for those with capital and courage. Distressed properties, foreclosures, short sales, or neglected homes are abundant, and motivated sellers accept below-market prices. Investors who recognize early recovery signs, declining inventory, stabilizing employment, or improving lending conditions, can acquire properties at steep discounts. This is the ideal time to buy, particularly for long-term holds, as rents and values will rise as the cycle progresses. However, recovery requires patience. Immediate flipping may be risky unless the local economy shows clear revitalization. The expansion phase emerges as confidence returns. Job growth accelerates, demand outpaces supply, and prices climb steadily. Developers begin new construction, but it takes time to complete, keeping inventory tight. During expansion, buy and hold investors thrive, as rising rents and depreciation build equity. Flippers also benefit, as renovations can quickly yield profits in an appreciating market. However, this phase demands caution. Overpaying for properties in anticipation of endless growth can backfire when the cycle peaks. Savvy investors focus on neighborhoods with strong fundamentals, good schools, infrastructure projects, or employer relocations, rather than chasing overheated markets. Diversifying into undervalued secondary markets can also reduce risk. At the peak, the market reaches its zenith. Prices have soared, new construction floods the market, and euphoria leads many to believe the boom will never end. This is when amateur investors often jump in, fearing they've missed out. Warning signs include speculative buying, e.g., homes selling within days at inflated prices, excessive leverage, and media hype. For seasoned investors, the peak is a signal to sell overvalued assets or hold conservatively financed properties with strong cash flow. Flippers should exit completed projects as price growth stalls and competition increases. Long-term holders might refinance to lock in low rates but avoid over-leveraging. The key is resisting greed. Selling near the peak preserves gains and provides capital for the next downturn. The recession phase arrives when supply outstrips demand, prices stagnate or decline, and economic conditions weaken. Rising unemployment, higher interest rates, or reduced lending. Distressed sales rise, and panic selling exacerbates the downturn. During this phase, cash-rich investors with long-term horizons can find bargains, but timing is critical. Buying too early, before prices bottom, can lead to further losses. Instead, watch for stabilization indicators, such as shrinking inventory or policy interventions, e.g., rate cuts. For most owners, holding quality properties, those in desirable locations with sustainable cash flow, is preferable to selling at depressed prices. If you must sell, consider lease options or seller financing to attract buyers in a credit-constrained market. Beyond these phases, external factors, like interest rates, government policies, or technological disruptions, can accelerate or prolong cycles. For example, remote work trends have permanently altered demand for office space while boosting suburban housing markets. Investors who monitor these shifts can adjust strategies accordingly. Real estate cycles are inevitable, but they don't have to be unpredictable. By studying local trends, maintaining financial flexibility, and aligning actions with cycle phases, investors can navigate downturns and capitalize on opportunities, turning market volatility into a strategic advantage. Whether you're a flipper, landlord, or passive investor, recognizing where your market stands in its cycle is the first step toward making informed, profitable decisions.